Hello. At the best of times, economics and financial markets, I think, are hard to explain and understand. At least they are for me. Some people have come up with much more clever and intuitive ways of explaining what goes on with economies, how capital gets distributed across economies, and also how capital flows into and out of asset classes in financial markets. The best one I've come across comes from the late Bill Phillips, the economist who's given his name to what we now call the Phillips curve. And some time ago, Bill Phillips came up with a machine. He actually built a very large and clunky machine with lots of levers and buttons. And the idea of the machine is that coloured liquid would pass through it at different speeds depending on how you turned buttons to mimic fiscal policy or monetary policy. The idea being to demonstrate to politicians and some policymakers how an economy traded off different aspects of fiscal policy and monetary policy. It really is an ingenious device. I took the example of the Phillips machine and used it in an opinion article in the FT Alphaville section last week, where I tried to apply this to the workings of the euro. And what I was trying to get across is that for certain parts of the eurozone, capital flows more freely than it does for others, perhaps on the periphery of the eurozone. The article's on the FT website, but at very least, do have a look at the video that the FT people have put up of Bill Phillips' machine. It's really appealing and intuitive. And I thought of Phillips' machine when I looked at some of the market behaviour this week. Midweek after the Trump speech, we had a really strong run-up into risky assets, in particular to equities, which didn't necessarily seem to be linked to fundamentals, earnings, valuations, the macro outlook, the outlook for central banks. And there is a sense, I think, in markets, with valuations now pushing very high levels, that the market is driven by animal spirits and by flows. And I think the story of the last year or so, if I can take my props, is that capital or liquidity has been flowing from safe assets, when this time last year we were obsessed about deflation, to riskier assets. Now we're having reflation. And you'll see, just to get a sense of the way the flow dynamic has been moving. What we've done on the team is try and look at as many sources of flow data as possible. And they show the following. If you look at companies, corporate insiders, chief executives, CFOs, and companies themselves have actually been selling rather than buying. And these types of participant, I think, tend to be much more sensitive to valuation. So now the valuations are high, companies and CEOs are actually selling equity as opposed to buying it. Institutional investors, I think, on balance, have been more muted and maybe paying more attention to things like valuation, maybe a benign outlook for economies, but maybe not a very rosy one in their view. So institutional flows into equities have not been as strong, perhaps, as market action would suggest. Hedge funds as well have been quite cautious with risk and have not, it looks from the data, taken really big risks in risky assets. So their returns are positive, but not as high as some of the overall equity indices have performed so far to date. The really big change in flows comes in mutual funds and retail flows into equities. And there's been a very strong effect. And it suggests that the retail investor, who perhaps is more sensitive to political watersheds and, I think, to the business cycle, is really putting capital to work in markets. And a lot of this is coming in through passive instruments, ETFs. Of course, all of this flow activity will reignite debate about smart money, non-smart, or what some people uncharitably call dumb money. I think the retail flows are much more sensitive to momentum. The institutional hedge fund flows may be more sensitive to things like valuation. The issue, I guess, is whether you follow momentum. Well, my rule is never to do something simply because other people are doing it, and particularly when some of the fundamentals don't really argue for doing that as well. I think at the same time, going against a herd can be quite dangerous, and maybe that makes this market in the short term quite difficult to arbitrage or to go against. What's going to be the next phase? Well, the next phase is again back to liquidity. What are the central banks going to do? And we've got a couple of really crucial meetings coming up. In the middle of March, we've got the Fed. And most of the Fed Open Markets Committee have now come out in public and hinted that they are going to raise rates in the middle of March, and that's being priced into markets. Keep an eye also on the People's Bank in China, where through macroprudential measures they are at the margin beginning to tighten. So watch the central banks for signs that for the first time in a long time the liquidity tap is being turned off. If that is the case, there may well be a change in momentum in the markets. Thank you.